Welcome everybody to our second financial planning workshop. These workshops are sponsored by the American Association of the Individual Investors, AAII, and also by the Los Altos Library. And I just want to make the point that any of the views expressed here tonight are my own and not necessarily sponsored or not necessarily directly adhered to by the AAII. My name is Fred Smith. I'm a registered investment advisor and retired financial planner. And I've given you my email address up there so that if there are any questions come up, or if you want to get a little more clarification on anything we discussed, or if you disagree with anything we discussed, feel free to email me at that email address, and I'll try to respond to them all. Also, you have the webcast is details for either signing up for the next one. There'll be a link to sign up for the future workshops at our local Silicon Valley chapter website, the www.siliconvalleyAAII.org, and also the slides for tonight's show will be there as well. We also have recorded last month's workshop, so if you go to that website you can get access to the recording too. Last month we covered the fundamentals of investing at that workshop, and tonight we're going to be looking into building a diversified portfolio. Next month and the month after will be two more investing workshops, followed early in the 2017 with 3 workshops on retirement planning, and then we'll do Social Security and Medicare, and finally end up with one on estate planning. All of these workshops will be live here in the Los Altos Library on the second Wednesday of the month at 7 o'clock, and we'll attempt again to broadcast them on the webcast them simultaneously and do a recording. Hopefully tonight we'll be able to do better next time than we've done tonight. Last month, as I said, we did the fundamentals of investing. At that point, we spent some time looking at your PIP, your personal investor profile, and how to write that up, just a half-page summary of who you are. And then we also looked at various methods to measure risk return and techniques to control risk. And we spent a fair amount of time looking at a whole string of investment vehicles, from individual stocks and bonds through mutual funds, exchange-traded funds, REITs, and stuff like that. And in essence, last month it was pretty basic for a lot of folks. I apologize for that, but we needed to make sure that everybody was up to speed on the tools that we need for tonight and for the future workshops. And all these slides are available at our local website there, and also the webcast recording from last month is there, or a link to it. Today we're going to be covering initially modern portfolio theory. We'll spend a little time on that. Then we're going to look at the various asset classes and the characteristics, the similarities and differences between them, before we get into building a diversified portfolio, and then looking at ways to rebalance it. And finally, we're going to do that second document to go into the All About Me folder, your investment policy statement, the IPS. Mostly you should be aware that what we're going to be talking about tonight in building a portfolio is using mutual funds, index funds. And if anybody's here wanting to find out how to pick the latest great techniques for picking individual stocks or whatever to build a portfolio, I'm sorry, I'm not going to get into that tonight. It's just going to be index funds and using modern portfolio theory. The theory itself is a way of explaining how risk-averse investors can build a portfolio to maximize their return for a given level of risk, or vice versa, to minimize the risk for a given return that they might require. And it was first formulated by Harry Markowitz back in 1952, but Bill Sharp and a number of other folks have developed it beyond that since then. Last month I showed this slide, showing how risk and return are very strongly correlated. You've got the return on the right-hand side and the standard deviation representing the risk on the bottom, and we're showing that for T-bills, you've got a very low risk, but you've also got a low return. And then for bonds, short-term, intermediate-term, long-term bonds, the risk gets a little higher, especially when you go out to long-term bonds. The return gets higher and the risk gets higher. And when you go out to stocks, and what I'm showing here will be, I think this one here is the total stock market. This is large cap stocks. This will be the extended market or small cap stocks, which are obviously a higher return, but they're really getting out there on the risk scale. But the message, the takeaway from this is that the risk and return are in fact heavily correlated, and there's no concept at all that you're going to be able to get a high return without also taking the risk. And any cold calls to get telling you otherwise are either stupid or lying. The two definitely go together. Tonight we're going to look not only just at the return and the risk as measured by the standard deviation, but we're also going to look at what I call the third dimension, and that's the correlation between the assets. The correlation, the correlation coefficient for two assets that track each other perfectly. When one zigs, the other zigs, and one zags, the other zags. If they track each other perfectly, we'll have a coefficient, a correlation coefficient of C equals 1, plus 1. If there's no relationship at all between the two of them, where there's no correlation at all, and basically knowing what one asset does tells you nothing about the other, in that case the coefficient will be 0. And if it's perfect negative correlation, C equals minus 1. When one zigs, the other zags, and vice versa. Perfectly out of sync with each other. That would give you a C equals minus 1. It's a nice holy grail to shoot for, but as you'll see later, we don't get quite there in practice. If you look at the equations for modern portfolio theory, you assume two risky assets, A and B. I'm using the term risky here as in a financial sense or the economic sense, where as opposed to risk-free. I don't mean, it's risky, you wouldn't want to go near that. I'm just saying it's got some level of risk. It could be a little risk, it could be a lot of risk that's yet to be determined. But you've got two assets with some risk, and we want to see if we put them together in a portfolio, how that portfolio, what the characteristics of that will be. We're assuming that for the individual assets, they have return of R sub A and R sub B, and standard deviations of S sub A and S sub B, and correlation C sub AB. And we're assuming that we mix them with weights W sub A and W sub B. The return for the portfolio is just the weighted mean of the two means for each of the individual assets. So that's a nice simple equation that gives you pretty much what you'd expect, intuitively. The standard deviation for the portfolio is this horrible equation at the bottom. It's not quite as bad as it looks, but it's not a nice, neat, clean expression. But any of you math whiz kids out there may want to take a quick look at what happens when CAB at the end, when the correlation between the two assets is unity. If they're perfectly correlated, that whole long expression condenses down to the weighted mean of the two standard deviations. It turns the exact same form as for the return equation above it. In other words, this one here, if you take the correlation equal to unity, perfect correlation between the two assets, then it condenses down to the same form as this equation. So it's not quite as bad as it looks. Okay, so if we take an example for these two risky assets, supposing the first asset might be a bond fund, and let's just assume it's got a return of 6% and a standard deviation of 5%. These are long-term figures, so you may have a problem with 6% today, but over long term, that's not an unreasonable number. For the second asset, we're assuming a return of twice that, 12% return, and a standard deviation of 18%. This could well represent, a stock fund. It'd be a fairly aggressive stock fund, but it's not unreasonable for a stock fund. And we're going to look at what the return is for the portfolio with various weights going all the way from 0 stocks and 100% bonds all the way through to 0% bonds and 100% stocks in 10% increments. And we're going to see what happens as the correlation varies between perfect positive correlation of +1 through random correlation to perfect negative correlation with C equals -1. So the first case we're looking at here are for these two assets with the correlation, perfect correlation of 1.0. And you can see, the bonds down here, the 100% bonds in the portfolio with the 6% return and the 5% standard deviation. The other extreme, you've got the 100% stocks with the 12% return and 18% standard deviation. And then these are the 10% increments here. 100% bonds, this is 90%, 80%, 70%, and so on, all the way up to 0 bonds and 100% stocks. And you can see this is a nice linear equation. It's straight line, no surprises. With perfect correlation, there's everything works pretty much as you would expect it intuitively. So let's see what happens if you have less than perfect correlation. What happens if you still have positive correlation, but in this case it's +0.5. And this equation looks very, the graph looks very similar to the other one. You've still got the 100% bonds down here. There's a little bit of a kink here that's not, it might be a little bit of a surprise, but it's not a straight line, obviously. But it's very similar to the previous one. So if we push that a little bit further, and we look at what happens when you got 0 correlation. You've got, the action of one asset has absolutely nothing to do with the action of the other one. In that case, this kink at the bottom has become a lot more pronounced. If I can find, here we go. You can see that, again, the 100% bonds here with the 6% return and the 5% yield, but this kink is bent back a little bit before it takes off up towards the 100% stocks. This is kind of interesting because it shows that if you started off with a portfolio of 100% bonds with 6% return and 5% standard deviation, if you feed into that, salt into that a 10% share of the really risky asset of the stocks, you actually get a higher return, which shouldn't be a big surprise, but you get a lower risk, and that is a little bit strange. So let's explore that a little bit more and see what happens when we go to a negative correlation. This is negative 0.5. In this case, I got to find, here we go. In this case, you can see this kink has gotten really pronounced now, and this begins to look really interesting because here you find out that with a 10 or 20% share of the risky stocks salted into the bond portfolio, you've boosted the return from 6% to somewhere in the region of 7%, and that, that's not a surprise. That's kind of what you'd expect. But the risk, the standard deviation, has dropped from 5% down to a little below 4%. So now you've gotten a higher return and a lower risk. So this is the free lunch here on the negative slope part of the graph, where you get not only a higher return but also lower risk. They say that MPT gives you the only free lunch in investing, and that's it right there. That's about as far as you can typically go in practice. In fact, finding two assets with a negative correlation of 0.5 is pretty difficult to do. But just for the theoretical fun of it, I wanted to see what happens when you push all the way out to perfect negative correlation. I don't know of any two assets that actually do this in practice, and if anybody does, I'd love to hear about it. In fact, I'll buy you lunch. How about that? In this case, what you're seeing is that if you add 20% stocks into your bond portfolio, not only do you get the yield up over 7%, but you get a zero risk. With perfect negative correlation and the right weightings of your two assets, you can get all the way to a risk-free portfolio. So in practice, you never ever want to be down here anywhere, because you can always get a better return and lower risk by feeding in some more of the stocks. So that's how MPT works, and that's the basic concept behind it. So what I want to look at before we move on, are there any questions with regard to modern portfolio theory? We'll be coming back to a lot of this later on, but I just wanted to lay the groundwork here. I should say also that this is a workshop. I mean, if you want to, I can stand up here for 2 hours and spout on, but that's not really the intent. It's meant, it really helps. I'll be glad to take whatever questions people have. If you need something clarified, or if there's something you don't understand, chances are your neighbor might not understand it either, or something you disagree with me on or want to discuss, we can do that, because there's kind of time built in for a little to and fro on this. Yes, sir. There's a question back here. Zero which? Oh, the question says zero risk appears naive. That's absolutely a true statement. Yes. If you remember rightly, when I showed that one, I did say that in practice, I don't know of any two assets that would give it. Think of this particular curve as a theoretical one, and in practice, this would be the holy grail. It's what everybody likes to shoot for, but I don't have any way to get there. So any way of getting to zero risk in a portfolio like that is indeed naive. You're correct. Any other questions? Yes. I hadn't figured on going into it, but intuitively, I think everybody likes to get less and less risk, and shooting for zero obviously sounds like a great thing to do. Okay. For those on the webcast, the question relates to the not just to the desirability of getting to a zero risk, but to the cost of getting there. I guess it depends on, my response would be that it depends on where you're starting from. If you're starting from 100% bonds, the cost of getting to zero risk is negative. You get it for free and then some. If you're starting from 100% bond stocks, then the questioner is right in that you are giving up some of the yield of the stocks in order to get to the zero risk. But if you go back to the very original graph that I showed, where risk and return are correlated, you expect that there will be some cost in going to either lower risk or more risk if you're going to go to higher returns. Apart from this little negative section of the graph, there is no free lunch. Any other questions? Yes. The question relates to modern portfolio theory and whether it's just based on theory or whether it pertains to the real world, to actual stocks and bonds. Over the next half dozen or more slides, maybe more, I'm going to be looking at how modern portfolio theory applies to a number of actual funds, index funds. We'll be building up portfolios using those. So if you hold that thought for a few slides, we'll cover it as we get into it. Any questions from the web? No, to the best, the question is whether I can give an example of two assets that have a correlation of -1. I wish I could. That's why I say I'll be glad to spring for lunch for anybody that can bring me those two assets. That'd be a good deal. It's a theoretical number, and that's why I put this up here, just to show the limits of the theory and where our goals are would be to get there. But in practice, to the best of my knowledge, there's nothing that comes even close. Okay, if there are no more questions on the theory at this point, I'm going to move on and look at a number of the asset classes and how they work together. Before I get into the details of the assets themselves, I want to explain to you why it's so important to look at these. Back in 1986, Gary Brinson, along with a couple of other authors, published a paper reporting results of a survey that they did on a large number of major pension funds. This was not just a half dozen accounts. They looked at 82 major pension funds, across the nation, and the conclusion that they drew from that was that the contribution to the variance in the portfolios was 91% of it could be explained by what they termed investment policy decisions. And what that meant really in English was that it's deciding on what your asset classes are and what the weights are for those asset classes. For those folks who want to spend their time doing security selection within an asset class, in other words, stock picking, that contributed less than 5%, and trying to time the market contributed less than 2%. So those folks who consider themselves, die-hard investors that want to spend every evening or every weekend on the computer trying to pick the ultimate, high growth stock or high dividend stock or whatever, or the right time to get in and out of the market, are probably not spending their time as wisely as they might, because the returns from that are much, much less. And the real contribution is to go back to your PIP that we talked about in the first workshop, that figure out what your risk tolerance is and what your time frame is and so on, and using that information pick the appropriate weightings that you want for your asset allocation amongst the assets. And you'll get some guidelines as we go through this tonight as to where that would be. But if you're putting the bulk of your energy into trying to decide which assets to pick from and how to weight them, that's where you should be doing, and spending a lot less time doing stock picking and trying to time the market. You can gauge my personal dent coming through in this a little bit as well, I think. Okay, so what are the major asset classes? Well, under fixed income, we have cash and cash equivalents, and we have bonds. And on the equity side, we have stocks. So you've basically got those, you've got cash, you've got bonds, and you've got stocks as the three major asset classes. We're going to be looking at those tonight, along with a couple of other aspects as well. And we'll see what the individual characteristics look like, and what how they mesh together. For 3-month T-bills, I'm using this as for the cash equivalents, because it's a very safe asset. And back prior to 2007, 2008, you could actually get a halfway decent return. You could get 3, 4, 5% from T-bills. Since 2009, that's gone basically down, not quite to zero, but almost to zero. And it's been negligible. That's after the Great Recession. But the big thing to note from this is that there are no negative years. Even in the years after 2009, where the returns are very, very low. They've not gone negative, and so it's a safe asset. If you put numbers on the graph that we've just been looking at, the total return, the mean value of the total return is about 2.3% over the 20-year time period. Standard deviation is about 2.1%. Sharpe ratio by definition is 0, because the Sharpe ratio, if you go remember back to last month, was the difference between the the portfolio in question and the risk-free portfolio divided by the standard deviation. So if the difference is 0, then the Sharpe ratio has to be 0. Just for the record, I put in the best year was 2000, when it had a 5.24% return. Worst year was 2014, which was basically 0. And like I said, the important thing to remember here is number of down years, 0. 20 years with no down years. So that's what the cash and cash equivalents looks like. How about the bonds? What I'm showing here is the Vanguard Total Bond Market Fund, VBM FX. I've picked Vanguard partly because I like Vanguard, but that's not the real reason it's here. Vanguard is a great source to go to for all of the index funds with a long track record. I mean, you can get 20 years worth of data here, easily, and compare it with for the bonds to the stocks to REITs or whatever else. And most other companies, you'd be challenged to get that long a track record with index funds. So for bonds, for the total market bond fund, you've got higher returns than cash. That's the first thing that's very obvious here. You can get 6, 8, 10%. There's even one year that's over 11%, and that looks pretty good. But whoops, there are 2 years that are down. There's 1999. 1999 here is a negative year. It's only a negative little. It's less than 1%. And 2013 is a negative year where it looks like it's over 1%. Not a big deal, but that's the price you pay for the higher returns. Is be prepared to have some downside. Putting numbers on those, you see that the mean value for the total return is 5.2%. That's a lot better than for the cash, but the risk is higher. It's got a standard deviation of 3.5%. You still get a pretty good Sharpe ratio. Sharpe ratio 0.84, and best year was 2000 with 11.4% return. Worst year was 2.2 negative in 2013. Not a bad worst year. The 20-year record. That's a pretty good stretch, and you did get a fairly decent return for it. But for those folks that are nervous about down years, this was down for 2 of the 20 years. In other words, 10% of the time. So let's now look at stocks. And again, I've picked the Vanguard Total Stock Market, VTSMX. Again, it's got a 20-year record that's easily accessible. And boy, some of these returns look pretty good, 20, 30%. But guess what? There's a pattern here that a lot of folks will probably recognize. In fact, I think it's probably etched on a lot of people's brains. For those of us old enough to remember the 2000, 2001, 2002 catastrophe, we got 3 years in a row where the stock market was down. And it was down significantly. It was down, 8%, 8 or 10%. One year was down over 20%. And then 2008, whoops, that's a big cost to pay. That was down, I think it was 37% in that year. So the price for the higher returns in a lot of the years is 4 down years with significant down draws. And again, putting numbers on that, we've got a total return mean value of 10% over the 20 years. The risk, wow, standard deviation is 18.7%. That's a pretty volatile portfolio. Sharpe ratio is 0.41. It's much lower than the bonds because of, in spite of the higher interest, the income, in spite of the higher total return, it's got that huge standard deviation which drives down the Sharpe ratio. Best year was over 33%. That's attractive. It's nice to see it, but you can't get suckered into it and forget about the worst year, where it's down 37% negative, 2008. So I was actually down 4 years out of the 20, or 20%, 1/5 of the time. So to go back to our modern portfolio theory, what happens if we put the two of those together, the bond fund and the the stock fund. I see that our slides jumped around a little bit here, but well, I can explain it to you. If you start off with an all bond fund, no, you know, with 100% bonds, instead of leaving it 100% bonds, you go to 90%. I've got to find my arrow. Go to 90% bonds and salt in 10% of the stock market. So we're starting off. We have a mostly bond fund still, but we've put in 10% of the stock fund. Let's see what happens when we do that. Oh, the returns look a little better than for the total bond fund. That shouldn't be a surprise. You know, if you're putting 10% stocks in there, you'd expect that to bring the returns up a little. And this is quite respectable. 6, 8, 10%, one or two, 1 year. That's almost 12%. You see what's happened down at the bottom? There are no down years. That's the real benefit from doing this. It may come as a little bit surprise, but if you remember rightly, in 1999, the bond fund was down, but the stocks brought it up here. 2000, 2001, 2002 were down for the stock market, but the bond funds had enough yield here to overcome that. And even back in 2008, with the huge stock downdraft here, the bond yield was enough to salvage that. So you got 20 years in a row here with this simple two-asset portfolio with a decent return and no down years. So that's the real benefit from modern portfolio theory. You know, putting the numbers on that, you know, I said we've got the 90% bonds, 10% stock. You got the return for the portfolio has gone from 5.1% for the 100% bond fund. You know, if it's only 90% bonds and 10% stocks, it goes up to 5.6. It goes up a little bit. That's not a surprise. The standard deviation has gone from 3.5 for the bond fund, dropped to 3.0 for the portfolio. So not only did the return go up, but the standard deviation for the portfolio is lower than either of the two components going into it. So that shows the benefit of the mix. Sharpe ratio has gone up to 1.11. That's a pretty good Sharpe ratio. Best year was slightly better than the bonds, not a whole lot better. Worst year, instead of being negative 2.2, worst year is actually 0.3%. It's still positive. So out of the 20 years, there are no down years. So that's just a very simple, conservative two-asset portfolio. But you can see the benefit of mixing the two together. Any questions on that? Yes. Are you talking about this chart? Oh no, you're way ahead of me on that. We haven't gotten to. No, you're half a dozen slides ahead of me. Yeah, we'll get to that in a minute. This one. Yeah. Okay. Now, for those on the webcast, the questioner is saying that this chart with the total stock market return data on it is a little misleading, because if you go down by 37% in 1 year, going up 37% the next year does not bring you back to even. That's a true statement. But for getting, the chart is a year by year by year is what it is. If you look at the actual data over the 20-year period, the average value for the total returns over those 20 years is 10%. Perhaps more importantly, the compound annual growth rate over that full 20-year period is 8.2%. And that includes the down years, the up years, the good, the bad, the ugly. It's all built into those numbers. So for better or worse, that's it. It also shows up in this case. The high volatility, shows up in this case with a very, very high, relatively high standard deviation. Any other questions? Okay, so the last chart that I showed you was a very simple two-asset portfolio with mostly bonds, 90% bonds, and with 10% stocks. And that might be appropriate for somebody in, with a conservative risk tolerance in retirement or something like that. But some folks might want a higher return and be prepared to take a higher risk. So the question is, what happens if you move to the other end of the risk spectrum, up closer to the stock portfolio, and you have 70% stocks and 30% bonds. So again, what we're doing in this case, and my slide has gotten a little messed up here. This is the bond portfolio with a 30% allocation to it, and the stock portfolio with the 70% allocation. When we run the numbers on that mix for the simple two-asset portfolio, we get this chart here, and it looks a lot more like the stock chart that we looked at earlier. But you can see that it's got the same 3 down years in 2000, 2001, 2002. It's also got a down year in 2008. But because of the 30% bonds that are blended into it, it's got the negative years are not as bad as they were in the case of the 100% stock. So looking at those here, if we'd started with 100% stock, we would have had 8.2% compound annual growth rate. We've lost 0.5% because of the 30% bonds that are mixed into it. But what we've gained on that is that the standard deviation has dropped from the horrible 18.7 down to a much more tolerable 12.8, and the Sharpe ratio has come up a little bit, up to 0.49. So for somebody that's willing to take on more risk, this could be somebody earlier in their career, perhaps, with a more aggressive risk tolerance. Something like 70% in stocks and 30% in bonds might not be an unreasonable place to be. Now, in this one again, the worst year had dropped from 37% negative down to about 24 negative, and we still had 4 down years. So there's still some risk there, but it's moderated somewhat. Now, if we wanted to diversify a little more beyond that, what could we do to diversify more? One thing we might do is still hang on to the 30% in bonds, but take the 70% in stocks and add those, or put in a mix in there instead of the fixed 70%. Put 30% in large cap stocks and pick the Vanguard Index 500, which is large cap blend, the largest 500 U.S. stocks, as 30%. Mid and small cap stocks 30%, and I've picked the Vanguard Extended Market, the VEXMX, for that. 30% for that, and then 30% for real estate. The extended market is actually just the total market minus the Vanguard 500 stocks. And for the real estate, I picked the Vanguard REIT, which is VGSIX. So if we look at the charts for those, the Index 500 VFINX looks very similar to the total stock market. The shape is very, very similar. The numbers are slightly different, not a whole lot, but that shouldn't be a surprise because the total stock market is weighted very heavily by the 500 largest companies. So yeah, you'd expect there to be a lot of similarity here. For the extended market, the shapes look about the same. You've got the same 3 negative years in 2000, 2001, 2002. the same negative year in 2008. And whoops, got another negative year over here in 2015. And these numbers are actually slightly worse than for the total market, because we're now looking at the heavier weighting for the small cap stocks. For the REIT, as I said, we picked the Vanguard VGSIX, and it's pretty volatile too. It's all over the place. There's some 20, 30, 35% years that are good, and you've got a bunch of down years as well. You've got 5 down years, it looks like. But there's something interesting here for those that are looking at it more carefully. The down years here, 1998 and 1999, if you remember your U.S. stocks, the S&P 500 or even the total stock market was up in those 2 years, and the 3 years in a row when the stock market was down, 2000, 2001, 2002, the REIT is up. So there's some help to be gotten there in cancelling it out. 2007 was negative for the REIT. 2008 was a big negative as well, and that's the big negative on the stock market as well. So the diversification doesn't help you at all there. The only place to hide in 2008 was to be heavily into bonds. Almost every equity fund known to man had a horrible time in 2008. So we can expect the REIT to give us some help in this area, but not much help over here. So let's see what the numbers look like. Oh, we have to go to look at the putting those 4 assets together. We've got the 30% in the bond fund as before, and then the 30% in the large cap US, 30% in the extended market US, and 10% in the REIT. And when we put all of those together, we see that the stock market bailed out the REIT in these years, and the REIT helped moderate these numbers a lot from in this period here. If you remember rightly, the stock market was down way down here, well maybe down here somewhere, in 2001, 2002. So adding the REIT in managed to moderate that to the point where you less than 10% there. 2008 we still have a big problem where you're looking at a big negative spike. So looking at the numbers, 8.2% for the compound annual growth rate, which is pretty good. If you remember rightly, for the 2-asset portfolio where we just looked at the total bond market and the total stock market, this was 7.7. So we've gained 0.5% by adding in the extra 2 assets into this portfolio, asset classes. The standard deviation is down. Actually, 12.6% is pretty darn good when you consider that we've got a fairly hefty weighting to all of these things running 18, 20, 21.5%. So if the total portfolio has a standard deviation of 12.6% with a Sharpe ratio of 0.53, those are pretty good numbers for a simple 4-asset portfolio. Best year was tempered a bit, obviously, from these really high numbers, but the worst year was was 25%, 24.9%, which is pretty darn good considering what these numbers all look like. But you do have 5 years out of the 20 where they were down, so you need to make sure that you've written up your PIP properly and you truly believe it. If you said you've got a high risk tolerance, this is where you're going to be asked to honor that statement. You get called on it. 5 years out of 20 is a fair amount of stomach crunching numbers. If you want a lower risk tolerance, instead of going 70% stock and 30% bonds, what happens if you switch it the other way around? If you do 70% bonds and 30% stock, so what you do then is go with 70% in VBMX bond portfolio, and 12% in the large cap stocks, 12% in the extended market, 6% in the REIT. So you'd expect this return, this portfolio with 4 assets, to have a lower return, but it should also have a lower risk.
$30 में लाइफ में वाला है उसका.
The chart for the 70% bonds and the 30% stocks looks like this, where you've got all of the volatility, all the negative returns here have gone, but the 2008 is the stocks are still broken through, but instead of being 37% negative or something, this is only about 8% negative. So this is a pretty good portfolio with just one down year, and maybe somebody with a fairly conservative risk tolerance might be comfortable with something like this. Numbers here are 6.7% for the compound annual growth rate, 5.2% for the standard deviation. Considering it's got some of these numbers salted into it, albeit in fairly small percentages, this is a pretty good number. And the Sharpe ratio of 0.88. The worst year was minus 7.7%, which is very surprising considering that it's got some percentage of these guys in there. So it's a real roller coaster for the individual components in there, but they all balance out at this. And it's got one year out of the 20 hertz down. If you want to diversify beyond that, that's four different funds in there. There are ways to do it, and I'm not going to go into them tonight because it takes too long to go into all the details of going much more complicated. But ways to do it, you can take your fixed income, instead of having one simple total bond fund, you could split it out into short, intermediate, and long-term bonds. You could break out munis if you wanted to put in some high-yield junk bonds. Although junk bonds actually don't give you that much diversification because they tend to behave just like stocks. So you want a very small percentage of those if you're going to use them. Or you could go offshore. You could go with some international fixed income. For the domestic equities, we've already looked at breaking out the large cap, mid cap, and small cap stocks. But you could also consider looking at breaking out the growth and the value stocks separately. And you can look at international equities. And if you really want to break those down further, you can go with developed nations and with emerging markets, or even frontier markets if you're really gutsy. But with any of those, the emerging markets can be pretty risky and pretty volatile. You probably don't want to, well, just to suggest a personal observation, you may not want to go much beyond 5 or 10% allocation to any of those highly volatile ones. Way back 3 or 4 years ago, Craig Israelson published a chart which I kind of like, showing the correlation between all the various assets. And this is not absolute cast in stone. It does vary a little bit, but not all that much. And even though this is for data up to 2012, I don't think it's changed a whole lot since then. But shown in red the negative, the negative numbers. And you'll see nothing here, but this is the most negative one of the whole bunch. Nothing that even goes down to the negative 0.5 that we looked at before, and certainly nothing close to -1. But on the other hand, there are a number of correlations here that are still, even though they're positive, they're very close to 0. So this gives you a good idea if you're putting together a portfolio yourself of the kind of things you might want to blend into it, and which ones are likely to have the most benefit for you. I love the term lazy portfolios. Is anybody here familiar with the lazy portfolios? Do they know what I'm talking about? Okay, great. Got one taker. If you go on Google, if you Google lazy portfolios or whatever, you come up with a number of folks who've taken a shot at using the Vanguard index funds, and they publish their very simple portfolios. Rick Ferrier, the very first one, is just a simple two-fund portfolio, 40% in the bond market and 60% in the stock market. Others get more elaborate with 3 funds and so on. These are all well-known money managers, and it's fun to track how they put together the various lazy portfolios. The reason they call them that is that mostly you just assemble them, and maybe once a year you might rebalance. But this is about as far as you can get from market timing or stock picking or whatever. This is based totally on what we've talked about up to now, and even here the most elaborate ones. This one here, for example, has 40% in bonds, where I've shown 10, 10, 10, 10. This is 10% in large cap U.S., 10% small, or it'd be large cap growth, large cap value, small cap growth, and small cap value. That's why the 4 in there. That's 1, 2, 3, 4, 5, 6, 7 different funds is the most complicated one on the sheet here. I think, well, maybe this other one is more. You've got 1, 2, 3, 4, 5, 6, 7, 8, 9 funds for Bernstein, but these are published fairly frequently, and and the data from them, and they're well known. It's just fun to track them, and they're all very practical portfolios. I mean, if you find one on here that matches your PIP, your whatever's in your personal investor profile, these are all very doable, very simple and easy and cheap to put together. Matt Hogan spoke to the AAII, to our local chapter here, I guess it's almost a year ago now, and he's with the ETF.com. He's an expert on exchange traded funds, and he publishes what he calls his 8 basis point ETF portfolio. It's a very, very, very cheap portfolio. He's got 6 different assets in it, as shown here, and he's got the percentage in each. And I included the exchange ratio or expense ratio. Some of these are very, very cheap. This is 4 basis points, 8 basis points, 6. The only expensive one here is the commodity, which is 0.5%. You need to be a little careful with this because this is an exchange traded note, and I think last month I explained some of the risks involved in trading exchange traded notes. But what I'm just showing you here is, again, a very practical portfolio for somebody that where this would be a reasonable match for their risk tolerance. And if it doesn't match, you can easily change the percentages around a little bit, but it's certainly cheap. These are all Schwab ETFs, with the exception of the bottom one. And I think actually Schwab has lowered the expense ratio on a number of these. So when Matt put this together a year ago and talked about 8 basis points total average or weighted average for the whole lot of these, I think that's probably down to 6 or 7 basis points at this point. Craig Israelson, again, is a well-known publisher, has what he calls his 7-12 portfolio. You've got 12 assets in 7 different asset classes, and I've shown the different asset classes here. And he just did equal weighting of 8.3% in each. So that's, again, another way of doing it, but it's the same idea. It's building on what we've talked about up to now. I've put together this list of mutual funds and exchange traded funds just as a starter kit for anybody that wants to build their own, for these asset classes. These aren't by any means the only ones there, but it depends on whether you've got your portfolio with Schwab or TD Ameritrade or somebody else or Vanguard. They all put together or offer very similar funds, but this would be a starting point that you can use, and most of the ones that I've shown here have a fairly long track record, so you can go back in and check them. Any questions so far on what I've covered? No? Okay, good. What I'm showing here is the simplest of the simple. You can't get any simpler than this. A one-fund diversified portfolio. Vanguard has their star fund. It's a fund of funds. It's basically a fund where they've taken
we'll look at a video.
a number of different of their own index funds, and they've blended them into various into a portfolio, and it's got very roughly, it varies a little bit at a time. They got roughly 37% bonds, 44% stocks, and 19% international stock. And over the last 20 years, up to the same time frame as on the other portfolios that I showed you, for 20 years ending in December 31st, 2015, they had a compound annual growth rate of 7.9%, standard deviation of 11.5 with a Sharpe of 0.56. These numbers are all directly comparable to any of the previous ones that I've shown you, and you'll see that fits right in. But you can basically buy just one single fund, VGSTX, and get a diversified portfolio that gives you a reasonable return with a reasonable volatility, a reasonable risk. Another way of doing one fund solution is to look at the target date funds. Is everybody familiar with the target date funds? Anybody? Oh. Okay. Any folks that have employer-sponsored retirement plans, behind those next January, I guess. But if you have a 401k or something like that, the chances are that they offer some of these target date funds. If a young person won't be retiring for 20, 30, 40 years, you might pick a 2050 target date, and those would be very heavily weighted towards stocks, and fairly small allocation to cash and bonds. But if you're closer to retirement, and you come into the you might pick a 2020 or 2025 fund. In those cases, the stock allocation would be a lot lower, and the bonds and the fixed income, the bonds and cash would be higher, and those automatically change. If you pick the one fund, you can stick with it. If you've picked it properly to begin with, you can stick with it for 10, 20, 30 years, and it will automatically change their allocation as they get closer and closer to your retirement date. All the fund families that I'm aware of offer them at this point. The numbers in the chart here are just averages from the 10 largest funds, but you can go to Vanguard and they have what they call the target retirement funds. Fidelity has Freedom K funds, T. Rowe Price, Alliance, PIMCO, Schwab. They all offer these. So again, like I said, they're very popular with 401k plans for folks who don't want to take the time and trouble and commitment to do their own asset allocation. Yes, sir. The question relates to the fund of funds, and whether the expense ratio takes care of all the trading between the funds and other commissions or expenses involved. If you take the Vanguard Star Fund as an example, you really are paying two separate expenses. You're paying the expense for the manager of the VGST who's picking how much of the large cap VFIN to put in there, how much of this, how much of that, and so on. And then you're also paying the expense for the individual funds, for the large cap. They'll have their own expenses. So you're paying both of those, but if both of them are small enough, it can still be worthwhile. But yes, sir, you're absolutely right. You're basically paying both expenses. Anything else on how the various assets and funds fit together? Is everybody happy with that? Okay, moving onward. How do you rebalance your portfolio? You know, you've taken the time and trouble to write up your PIP and figure who you are. You've taken the time and trouble to figure what asset allocation is appropriate for that. You've gone out and you've bought all the various funds, and it's all done pretty nicely for you. And now it's a year later, and you look at it. Geez, the thing's way out of whack. What do I do now? So you want to look at, spend some time looking at rebalancing. First thing is, a lot of people are not necessarily clear on this. The whole reason for rebalancing is to manage your risk. The problem is that in general, if you don't rebalance, the equity funds over long term tend to outrun the fixed income. And so if you start off with a 30% bonds and 70% stock, years later, a decade later, if you don't do anything, you're likely to wind up with 90% stock because it's grown faster and 10% bonds, and the thing would be out of balance. And the problem with that is that you're now taking on more risk than you'd intended. So the whole purpose, the reason for rebalancing is to manage that risk. It just happens that you generally or very often get a better return. Not necessarily, not always, but you besides getting the control of your risk, you can get a better return. Rebalancing is not easy. Psychologically, it's a real gut wrencher because you're doing the very opposite of what you want to do. Most folks say, well, you feed the winners and starve the losers. In this case, it's the other way around. You're feeding the losers and you're starving the winners, so that's not an easy thing to do. But what happens basically is that the funds that have done well over time have gotten a higher percentage than your initial allocation says they should, and the only way to get back is to take some money off the table for the winners and put it into the losers. And it can be gut-wrenching and difficult to do in practice, but that's what you got to do. You got to steel yourself to it. There are two fundamentally different ways of timing when you do it or how often you do it. One is to have it calendar-driven, and the other is to do it threshold-driven. For the calendar-driven technique, you basically say, okay, and on my birthday every year, I'm going to look at my asset allocation, and I'm going to rebalance it back to where it should have been, and I'm going to do that religiously on my birthday or on May Day or Labor Day or whatever date you pick. I suggest you don't pick December 31st. If you want to do that, you're better off to do January 15th or January 31st or something, because that way you'll have access to the statements that the brokers and the fund families will send out for the 31st. The other way of doing it is threshold driven or data driven. And if you're going to do that, what you need to do is check the allocation on a regular basis, certainly quarterly, maybe even more often, maybe even monthly, and see if it is within a threshold that you set. The threshold would typically be 10, 15, maybe 20% of the strategic value that you'd picked. And if when you check it, the actual allocation diverges less than the percentage that you picked from the strategic value, you say, okay, I don't do anything. But if it exceeds that threshold, then you need to rebalance. And the hope would be, if you've picked your threshold reasonably, correctly, that you probably only have to rebalance once in a while, maybe once a year or something like that. If you find yourself rebalancing more often, then you've probably picked too tight a threshold. As an example, supposing your asset allocate, your strategic asset allocation might have said that you wanted to have 20% of your portfolio in large cap US stocks or something like that. And let's just say you had a 10% threshold. If when you check it, if the allocation to your large caps in practice, if the actual allocation is between 18% and 22%, then you don't do anything, you just let it ride. But if the actual allocation is lower than 18%, or if it's higher than 22%, then you say, oops, I need to do something here, and you do you rebalance back to the strategic values. It's obviously more work doing the threshold driven technique, because you have to check more often than you do. I mean, with the periodic calendar-driven one, you just check once a year or whatever, and it's no big deal. With the threshold-driven one, you may check once a month, and you may only actually move stuff once a year, but you need to check it more often. By the way, if you're doing it on the calendar basis, rebalancing annually is probably a good a good way to go. You can even let it go to every 2 years if you want to, or you could do it every 6 months if you really want to do as well. You won't get too much of a difference, but don't do it any more frequently. Some folks figure, well, if doing it once a year is good, then it must be great to do it once a quarter. And geez, I'd love to do it once a month. You get not only do you get more work doing it more frequently, you actually get poorer results. Doing it 1 year is a good compromise. So how do you actually go about doing the rebalancing? We said earlier that you want to starve the winners and feed the losers. If you have an asset that's become overweighted, one way of doing it is to sell some of that asset and buy some of the ones that have not done as well. But that could, if you're doing that in a taxable account, you're going to run into tax issues and trading issues and so on. And you may have to actually sell some of them to do the rebalancing. But in practice, there are other things you should look at first. One way is if you're making contributions into the portfolio, maybe it's a retirement plan or something like that. You can do the rebalancing by allocating the monthly or quarterly contributions that you're making to whatever asset is underweighted to bring it back up. At the other end of the scale, for those of us who are over 70 and a half and taking RMDs, required minimum distributions from their funds, I'll talk about this again I guess it'll be in January. You can pull those RMDs out of whatever assets are overweighted, and you're going to have to take the distribution anyway. So you may as well use that opportunity to do some rebalancing. One of my favorite ways, the very simplest thing to do, is do not reinvest your dividend distributions. Put your dividend distributions into a money market fund, and then once every 6 months or every year, you can take the money that's accumulated in your money market fund and use that to purchase whatever asset is underweighted at the time. So it's a simple way to do it. Yes, sir. Yeah. The question relates to whether mutual funds allow you to put the dividends into a money market fund as opposed to reinvest them. Yes, to the best of my knowledge, you can. There's no reason why you can't. Certainly, if you're doing it with exchange traded funds, it's very simple to do. Yes. Yes, the question relates to the price you pay if you accumulate the dividends in a money market fund by not having that money in the equity at the time of getting the return of the market. Yes, there's a price, but normally what you're going to be accumulating in the money market fund will be the order of 1, 2, maybe 3% of the minimal amount, and that depends on how long you let it run. If you reinvest it every 6 months or something like that, the cost of doing that will be very, very small. Any other questions on rebalancing? Yes. That's a true statement. Yeah. Yes. The comment was that cost is what you're paying to be able to operate the thing this way. Yeah, there are costs, but in general, it's still a worthwhile way to go. It's a very simple way to go, so it works out for most people. The other comment I would make here is that most of the work-related retirement plans offer automatic rebalancing, and you just get onto their website and fill out how you want to rebalance and when. Any other comments on anything so far on building your portfolio, rebalancing? The question relates to the asset allocation, to the basic asset allocation decision. How do you handle the present low return, low interest rate environment for bonds? Is it a mistake to shy away from making your bond allocation because bonds have only one way to go at this point, and that's with the interest rate going up, and it's bad for bonds in general. The answer to that is yes, it's a low interest rate for bonds. Yes, bonds, the interest rate will be going up, but I believe it is a mistake to let that drive what you're doing here, because every year for at least the last 5 years, I've heard folks say, this is definitely bond, the interest rate's going up this year for sure. I'm going to stay out of bonds. I just don't want to take that risk. There's no way it can't go up. And I think we've gone up 1/4 of a point in 6 years or something. And it's, meantime, folks have been walking away from 2, 3, 4, 5% returns on intermediate bonds. And yes, I believe it's a mistake to let that drive it. If we were all that certain of the future, we wouldn't even be here discussing how to do a diversified portfolio. We'd all know exactly what to do at the right time. Okay, I want to spend some time on your investment policy statement, which is the second major, I shouldn't say major, the second important document that you should have in your All About Me portfolio. Remember rightly, last month I said you should open a folder and write up your PIP, your personal investor profile, and put a copy of that in there. And that could just be half a page. It doesn't have to be a big document. Pardon me. And this is the second document that goes with it. And again, it's not a long document. It's not a complicated one, but it's an important one. Yes, sir. I beg your pardon? Okay, well, no, okay. Okay. For the investment policy statement, what that really is a written agreement between you and your portfolio manager. If you went to a professional manager and said, hey, here's my portfolio, I want you to manage it for me, I don't know nothing from nothing, you take care of it. The first thing he should do is sit down with you for an hour or two and talk to you. And he'd think of it as an interview, but it's really just a discussion where he gets to know you, he gets to know your goals, your objectives, your hopes, your fears, your worst nightmare, and all the rest of it. And once he figures he knows you, he can work with you and putting together your personal investor profile, the PIP. But once you get that done, the data from that allows you and him to select what asset allocations are appropriate and to work through the techniques that he's going to use and the philosophy that he's going to use for managing your portfolio for you and what you're comfortable with. And he should actually ask you to, he'll write that document for you using your inputs, and he should very usually ask you to sign a copy, to initial a copy, so that you know that what you've told him to do, and he knows what you've told him to do, and as long as he does what you've told him to do, he can't be held accountable if the market works against you for a little bit. On the other hand, if he gets creative and goes off and does some stuff over and beyond what you've told him to do, regardless of whether it's a winner or a loser, you can hold him accountable and say, hey, that's not what I signed up for. Here's the document that we agreed to. You got to manage it this way. So what the IPS does is define how you want the portfolio managed. Now, that's great if you have an outside manager, but the exact same thing applies if you're your own manager. if you're going to manage this yourself, you really should sit down before you start moving any money around and figure, what's my philosophy here? What's my strategy? What am I trying to accomplish? And whereas the PIP takes care of the who am I, the IPS takes care of the where, what, when, and why, and how part of it, all the rest of it. So all of that should go into the policy statement. It will start with the PIP, and then if some of the data from that will get transferred over, but there's a bunch more stuff that goes in, because it basically sets the rules that are going to be used for managing your portfolio, and it also includes whatever limitations you want to put in there. The first thing that goes in there, obviously, starting point, will be what assets do you want to use, and what allocation to those, what percentage weighting do you want to put on each of those. And if you go back to the slide I showed you from the Princeton study, that's the real key to 91% of the variance in how your portfolio is going to perform, is how you which asset classes you pick, and how you match the percentage allocation to those individual assets against your PIP. It should also include whatever finer tuning you do within each asset class. You might say for U.S. equity 60%, it might include, say, how much you want in large cap, how much you want in small cap value, or whatever weightings you want there. If you want to, everything I've said here really talks about your strategic asset allocation, which is the long-term, big picture, and that will only change if there's a major change in your lifestyle, if you've births or deaths or marriage, divorce, or whatever, something major happens, that will change your PIP, that would feed through to this. But other than that should stay there. It should be fairly fixed. If you want to get involved in some tactical allocation, which is really tweaking the strategic values up or down a little bit depending on how you see the interest rates going, or where's the market at now, and stuff like that, you should set a limit on how much you're prepared to tweak it and under what circumstances, and that should be spelled out here. I'm not saying that you should go for tactical allocation, and most folks can't resist trying it, and most folks figure eventually that it didn't quite work out as I'd hoped. But if you want to do tactical allocation, you should define in your IPS how much range, what the range is, that you're allowed to vary the strategic values. What you should not do in your IPS is call out specific securities. Don't get down to that level of detail, because you might think today, oh, Google's a great stock, I want to put 20% into Google, blah, 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 for all the reasons. Don't forget what I said, is that your IPS should be a long-term document, and 5-10 years from now, it might be Google. What's that doing in there? So, if you want to add a certain percentage to, high tech or this or that or the other, it's okay to do it in a general sense, but at least allow the portfolio manager, be it an outside guy or yourself, the freedom to pick at the time, what the individual securities should be. Yes. The question relates to the strategic asset allocation, whether you should include your property. I assume you're talking about your home here. You have a real estate, is that what you're talking about? Some folks include their home, the home value in the total portfolio, and some don't. To some extent, it depends on whether you intend to live there the rest of your life or not, and it's something that you have to have over your head. So the argument would be, no, you don't include it, because it's not part of your investment asset portfolio. Other folks figure it's a major investment in real estate, and you should have your total asset allocation reflect that. Personally, I think that in practice it's easier to exclude it on the argument that if you're figuring on being there for the rest of your life, you're not going to trade it, you're not going to sell it, and it's providing a roof over your head, and that's the price you pay for it, but it's not going to affect what you do with your other parts of your fund. Oh, the question, what about rental income? If you have investment property, then that should be included in there. If you have rental properties, 2 or 3 homes or whatever, one home that you use to rent out, that should absolutely be included. That's part of your investment. That's part of your total portfolio. Yes. The actual strategy that you decide to use for your rebalancing should be in here as well. You need to just spell out the details of how you expect the manager to do the rebalancing. I've just given you an example here. You might want to agree to check it every quarter and rebalance if the allocation on any particular asset deviates by more than 10% from the strategic value. That's just an example. You can pick your own numbers, or you can say, hey, I just want to do it once a year. That's fine. But whatever you decide on, put it in writing. You'll see a couple of times in my slides here, my maximum. If it isn't written down, it never happened. If there are any things you do not want your manager to do, or you do not want your wife to do, or your spouse to do, or whoever it is managing your portfolio, this is the place to write it down. You may decide that if you're building a portfolio of stocks, that no one stock should be more than 5% of your total portfolio. And that means you have to have a minimum of 20 stocks in there to do that if you're going to do it. If you're building your portfolio from mutual funds or exchange-traded funds, you might say that no single security can never be allowed to get more than 15%, 20% of your total portfolio. You don't have to put a limit on this, but if stuff like that's important to you, this is the place to put it. Because if you don't put it here, the manager has free will to go off and do what he wants if you don't otherwise. You may want to say, I don't want to have anybody buying any securities on margin. On the other hand, you may say buying on margin is perfectly okay. I'm a fairly risk-taking kind of guy, so I don't mind if he goes off margining a portion of it. You may want to put a limit on what percentage margin he can run up. You may want to say no short sales or no derivatives. You may want to say no derivatives except writing covered calls is okay, but otherwise nothing. If you've got problems with the government or the philosophies involved in French West Africa or Uganda or wherever the heck you want, you may want to say I don't want to ever invest in any stocks from there, social investing. You may want to say I don't want any of the sin stocks in my portfolio. I don't want any tobacco and no Philip Morris, no Johnny Walker or whatever in there, just on principle. I'm not saying you should or shouldn't do any of these. It's totally a personal thing. But if you have strong feelings in any of this and want it to be reflected in your portfolio, this is the place to do it. I love this one. Some folks put out the challenge of, can you in 10 words or less summarize your investing philosophy? Can you take your IPS and condense it down to 10 words? Gus Sauter of the Vanguard says, if everybody wants it, I don't. Avoid crowds. That's not a bad philosophy. Morningstar's Don Phillips. Control what you can, your savings rate, costs, and taxes. In other words, that's stuff that you have directly under your control. Most of the rest of it you don't. And whether the market goes up or down, you just got to watch it happen, but you don't control it. Larry Siegel says, other people are smarter than you think they are. Index. Which is pretty much the same as what Bill Sharp says. Are you smarter than the average professional investor? Probably not. It means, again, index. He didn't say it here, but that's what he means. My own personal attempt to summarize it in 10 words or less is build a diversified portfolio of cheap index funds, rebalance diligently. And that's kind of what we've been talking about up to now. That's where my own personal leanings are. But rebalance diligently, to get into the 10 words, I couldn't describe my threshold dependent rebalancing technique, but that's what I meant. Rick Ferry, who's a well-known money manager, published what he calls his 6 rules for disciplined investing. I've included it here because, frankly, it gives a good summary of everything we've discussed so far tonight. Number 1, have a long-term investment philosophy. That goes back to your PIP. That should be spelled out in your PIP. And if you're investing, it, for the most part, should be on a long-term basis. Form a prudent asset allocation based on this philosophy. When you figure out who you are, then you got to figure out, your asset allocation. You got to figure out the where, when, why, and how part of it, based on that. Select low-cost funds to represent asset classes in the allocation. Again, that's kind of what we've talked. We looked at a lot of the Vanguard funds, which are all low-cost. We looked at Matt Hogan's 8 basis point portfolio, which is certainly low-cost. Number 4, maintain this portfolio through all market conditions. I think if I were Rick Ferry, I would have stopped there because the other 2 kind of don't add a lot of original to the first 4. The first 4 really where it's at. Where he says, don't change the asset allocation due to recent market activity. Yeah, that's correct. That's a good discipline to follow, but it kind of follows automatically from the first ones. And the last one, don't hold back on new investments. You're waiting for the market to clarify. Just to say, well, I'll wait and see what happens. You can wait forever for the interest rate. You can wait 6 years for the interest rates to go up. And meantime, the train's long since left the station on you. So I'm including those here as a sort of a summary of what we've covered so far. Any questions on any of this? Yes. The lazy portfolio one? Let me know when we get there. Oh, the quotes? Oh, no, I won't be back there. Okay. The question is, for these lazy portfolios, have any of them been particularly successful or not successful? I'm going to throw that back to you and say, what do you mean by successful? Well, it depends on what the meaning of the word is. Most of these will, first of all, with these, they are all diversified to some extent, some more so than others. As such, you're not going to get any earth-shattering 30-40% returns from these. They're going to be somewhat muted on the upside, but they will also be muted on the downside because they are diversified. That's the whole benefit of diversification and modern portfolio theory. I don't know for these in general. I haven't looked at each individual one. My guess, and it's only a guess, is that you're probably looking at, I'm going to give you 20-year average numbers now, because I don't care what I did last year, the year before, and the up and down. All of these probably come in somewhere in the region of 7 to 10% per annum over the 20-year time period, and they will probably all have standard deviations, maybe, I don't know, 10, 12%, something like that. They're going to be these are going to come in not too different to the star fund, that we looked at. Now, those are obviously top of the head numbers and so on, but if you Google these and go back and look at them, a lot of the data is published on a fairly regular basis, and I like them as a good indication of what you can get in practice without playing the stock market and without putting in every weekend crunching numbers, and fairly reliably get the market returns. Does that answer your question? Okay. Any other questions? Okay. Okay, so basically what we've covered today, looked at modern portfolio theory, what the theory and the practice here. We looked at how it fits into the various asset classes, what it takes to build a diversified portfolio, and also how to rebalance it. And we've looked at the IPS. Next month, I'm going to be on vacation, so we're going to have a guest speaker. We've got Alan Zimlowski will be filling in for me, and he's going to be doing a session, a workshop on Introduction to Computerized Investing. And what he's going to be doing first is looking at the the various websites that are available and how to use some of the spreadsheets. He's also going to be looking at what the data sources or resources you can get from the Santa Clara County Library. If you have a library card, a Santa Clara County Library card, you have free access online to Morningstar, to Standard & Poor's, to Value Line, and Al's going to be telling you how you can use some of these. You do not need to be a resident of Santa Clara County to get a library. Does everybody here have a library card? Okay, you should, because all you got to do is stop off at the desk and sign up for it. They need to verify who you are, but you do not have to be a resident of Santa Clara County. As soon as you have the card, you have access to their whole online resource, which includes Morningstar. I mean, you pay hundreds of dollars for this data if you're to do it outside the library. So it's a great resource to have. And yes. No, I don't. The Santa Clara County Library system has, I'm not sure if it's 5 or 6 libraries in it, but they are not run or funded or frankly connected with Santa Clara County. It's in the name, but and they're the ones providing it. I suspect that San Jose Library may provide a similar service, but I don't know. Campbell is part of the Santa Clara County, yes. Yeah, well, I mean, if your library card is not designated against any one library, the Santa Clara County Library card you can go to any of them, and you can also sit down at your computer and from anywhere and call up these resources. It's a great freebie, it really is. Al's also going to be talking about robo-advisors. I'm sorry I'm going to miss that. I would have enjoyed hearing that. Before next month's workshop, and this I think this is homework, but really, you can think of it as homework if you want to follow through on the workshops month by month. I started off last month saying you should open an All About Me folder and write up your PIP and put it in there. What I'm saying now is that you should review that PIP that you wrote up last month and see if you want to change it in any way based on what you've learned tonight. You should also write up your IPS and add that into the folder. And again, the old maxim, if it isn't written down, it never happened. So the reason for having it in writing is that, I was going to say if the market crashes 20 or 30%, let me be more pessimistic. When the market crashes 20 or 30%, you need to have a written document to go back to and says, what do I do now? If you don't have a written document to go back to and figure out what in the nice, cool, calm corner of your home years ago you thought it through, said you should do, you're going to panic and do all the wrong things. So it's only half a page each. Do it, folks. I've given you a whole list of reading material that covers a lot of what we've spoken about tonight. Most of it's available on the websites. Some of it's a little esoteric. I don't expect you to go back and dig out Harry Markowitz's Journal of Finance from 1952. You can take my word on that one. I've given you some useful websites here. The AAII.com, the national website, has a whole bunch of investing material on there that's worth browsing through. Also, our local, the local chapter that I gave you with for the slides for tonight and last month and the other ones has a bunch of data on there from some of the events that we've held on a monthly basis. There's a lot of good stuff there. The library is an obvious resource, which is worthwhile. All of the brokerage houses and fund families, they all have their own website, and most of them are pretty good these days. Vanguard in particular has a whole ton of white papers on there that gives you reading material on any topic you want. And I happen to like their stuff because it's in a language I can understand, and it's a philosophy that I can relate to, so I don't have any problem recommending that to anyone that wants to spend the time on it. Same thing goes for the Bogleheads. There's lazy portfolio data there, I think. Craig Israelson publishes data on his 712 portfolio from time to time. Rick Ferry has a blog. Mike Piper has a blog under the name of The Oblivious Investor. He's got some good stuff on there too. I couldn't resist putting this in. I mean, basically I've covered all the serious stuff that I wanted to do tonight, but I couldn't resist putting this in. The Motley Fool are a pair of two guys that are publishing data. They run some funds and so on these days, and they're pretty well respected. But I love their concept here. Imagine all the stuff you'd have to make up if you were forced to talk 24/7. Remember this when watching financial news on TV. This actually brings me to a point that this is fairly lighthearted, but it's actually a real point. The easiest way to control volatility. People often ask me, how do you control? The easiest way to control volatility is turn the TV off. The TV does more harm to folks' portfolio. The talking heads can get you into more trouble, and it's just not worth it. Turn the TV off. I'm not sure who the cynic was who wrote the next one. I'm not quite that cynical. Don't let Washington sway your investment decisions. Congress, I can't even read this. Congress has been a dysfunctional swamp of disappointment since 1789, and stocks have done well ever since. Warren Buffett, I really like this one. The role of stock forecasters is to make fortune tellers look good. And again, I don't know who the genius was who said that the correlation between confidence and future regret is incredibly high. And finally, my mandatory cartoon, Dilbert I like. Dilbert's one of my favorite guys. If your core holding is a falling knife, you can dollar cost average through the dead cat bounce. You guys know that? Again, turn the TV off. Are there any other questions on anything I've covered? That's all I have for tonight. A question here. My take on James Clear's new book. That's the level 3 investing. I haven't read the book, so I'm really not qualified to comment on it. It seems to me that what he's looking at is making the argument that you can take on more risk, that you can get higher returns by taking on more risk, and it's okay to move up the risk curve a little higher. Okay. The comment is that standard deviation as a measure of volatility is not really a real risk to the individual investor. I really can't comment on that. I don't know. I mean, it's not a bad viewpoint. There may be some validity to going down that path and exploring it some more, and I'm glad that he did. Any other questions? Yeah. The question relates to how do you come to grips with what standard deviation is appropriate for you? How do you make the choice of where you want to be? Two or three ways to get there. First of all, this is the fundamental question you should be addressing in your PIP. The whole paragraph is probably the longest section, 2 or 3 sentences in your PIP should relate to your risk tolerance. One way is to go to Schwab or Vanguard or any of these and pull up their risk tolerance questionnaire and sit down and answer a dozen questions on that, and it should give you and score them, and it should give you some indication of what your individual tolerance is. I wouldn't put a whole lot of faith in the detailed answer there, because you get somewhat different answers depending on which questionnaire you take, and a lot of them tend to come out, oh yeah, I'm a moderately conservative. Everybody seems to clump around around that one area, but it's still a good place to start. Perhaps a more rational place to start, I think, well, I shouldn't say a rational place to start, but a more useful place to look is, what did I actually do in 2008? What did I actually do in 2000, 2001, 2002? And if you look back at what you actually did back then, and you figure you got halfway through 2001, and geez, I can't handle this, I'm out of here, that tells you a lot about what your risk tolerance is. So whatever you think today, when things are going nicely, you might want to rejudge and say, would I still have felt it like that in the middle of 2001? Would I still have felt like that at the end of 2008? Would I in fact have had the intestinal fortitude to stick with my plan and not bail out on it at the wrong time? So I put a lot of weight into what you've actually done in the past, for those of us who have a history. But don't get seduced into thinking, I don't mind being an aggressive guy, I've got high risk tolerance. Easy saying that today, but you got to measure that against how you think back to how you actually felt at the end of 2008 and what you actually did. Any other questions? Question here. For our web listeners, the comment basically related to risk tolerance measurements and whether the actual measurements that you get, how they relate to the real life situation. There's a difference between the financial risk tolerance that you can survive and your own individual tolerance for taking risks, for skydiving or something like that. You may be a really risk tolerant type person and have that kind of personality, but if your finances don't allow you to do that, then you may need to rethink it and be a little more constrained. This is a perfectly valid point. One is basically your individual tolerance as a person, and the other is the financial environment that you're in. Does it allow you to be the person you want to be? Any other questions? If there are no more questions, we'll call it a night. Thank you, folks.
I have a question.